Ever felt like your business income vanished the second it hit your bank account? That's not just a feeling, it's probably your expenses. Welcome to the income statement, your business's quiet way of telling you we need to talk. You know, the conversation you've been avoiding. So you made some money, but how much of that did you actually keep? Here's the thing. Making money is just step one. Understanding what happened to that money, that's the job of the income statement. Let's unpack its 5 core elements. Revenue is the top line. It's the total amount of money your business brought in. Think of it as the highlight reel, you know, the big shiny number that makes you feel like you're crushing it. But here's the catch. Revenue doesn't give a crap about your costs, your staff, or if you're actually turning a profit. It just waltzes in, makes you feel all warm and fuzzy, and then quietly slips away when the bills start piling up. COGS stands for cost of goods sold, and it's the money you spent to actually deliver what you sold. If you're selling a physical product, it's the cost of materials, labor, and packaging. If you're service-based, it could be subcontractors or production costs. COGS is the middle part of the magic trick where your big juicy revenue number starts getting a little less juicy. Gross profit is what you have left after COGS, but before expenses. It's the halfway point, the we're not out of the woods, but at least we have shoes on number. Let's say you own a donut shop. You sell one donut for $3, that's your revenue. That's the money coming in. But making that donut wasn't free. You spent $1 on flour, sugar, icing, sprinkles, whatever it makes to make it delicious. That's your COGS. So now you've got $2 left. That's your gross profit. Here's the twist. That's not your take-home money just yet. You still have to pay rent, pay your staff, the light bill, and maybe even that subscription to keep the tunes flowing while you frost donuts. Operating expenses are everything else it takes to keep your donut shop running. Marketing to get people in the door, the register system, electricity to keep the fryer hot, and yeah, probably a little caffeine to survive the 4 a.m. bake. These aren't just tied to one donut, though. They're the behind-the-scenes cost of running the entire shop, and they creep in quickly. A delivery app fee here, a monthly subscription for your POS system there. One small charge at a time, your profits start thinning out like icing spread way too thin. Net income is the grand finale. The number you actually walk away with is the bottom line, the part that pays you. But here's the kicker. If your net income is negative, that's your business telling you that it's time for a serious talk. If it's positive, well, you're winning. But let's be honest, you could probably still use a few more donuts to celebrate. So here's the takeaway. Don't just oogle your revenue number and feel all warm and fuzzy inside. Look at your income statement like it's your business's reality check. It's not going to tell you that you're a genius. It's going to tell you if your business is a money-making machine or a donut-making hobby. And if you're not keeping enough after all that, well, might be time to put down the sprinkles and figure out where your money's actually going.